What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of January 2024, the first episode of the year. And by the way, I hope you're all having a great start to your year as well. But in each episode, I pick 3 new stocks that I feel are trading on sale at today's prices and for the long term. Now, to make things a little more fun and interesting, I also specifically choose one lower risk, one medium risk, and one higher risk option for added variety. Now, as always, though, just please remember to do your own research and make your own decisions. We only do this kind of really for fun, just to kind of see what's out there and available in the market, see if there's any stocks out there that are worth taking a closer look at. But either way, if you're enjoying the series and you're enjoying the channel, please consider subscribing. It'd be a great way to start the year off with more subscribers. It's something that YouTube really cares about right now, and it really helps keep my channel alive. So thank you for all of that support, everyone. It means a lot to me. But with all of that said, I can't wait to jump into this month's stocks. So let's go ahead and jump into it. And by the way, you'll want to watch all the way to the end of this episode, because the last stock that we'll be covering is actually a brand new one that I've never even mentioned before on the channel. So it's going to be a lot of fun to look at that one too. But I like all of these stocks. Can't wait to share them with you. Let's go ahead and jump into it. And let's start with the first stock. It's going to be our lower risk option, which I know, guys, I talk about this one a lot, but I just feel like Medtronic is still looking like an absolute steal right now, and I really have no idea why people keep sleeping on it, but I'm going to continue to buy shares while I can, because we're talking about a crash now of over 40% from the top for what is an absolute leader in the space. And really the thing about Medtronic too is that I just kind of feel like there are no other rivals in the space that are any better or even close. I mean, take surgical robotics, for example. We know that this is one of the highest growth markets for Medtronic at a compound annual growth rate of almost 17%, and it's expected to more than double in size by 2027. So who are the biggest rivals here for Medtronic to compete with? Well, there's companies like Intuitive Surgical and Stryker, which are great, but when you compare them to Medtronic, I mean, never mind the fact that neither of those even pay a dividend, while Medtronic is currently yielding one of the highest amounts it's ever been, and that's also after growing it for almost 5 decades in a row, making it really just kind of one of the best dividend stocks in the entire market, let alone compared to these stocks. But on top of that, their valuations are also way more expensive too, with Intuitive trading over 150% more expensive than the sector, while Stryker also trades 24% more expensive too. But Medtronic, on the other hand, they're actually 18% cheaper. And yet I would argue that Medtronic is one of the most diversified names in the space too. In fact, they sell more medical devices just in general than really any other company in the entire world, which is also a very dependable market long term, because the world isn't just going to all of a sudden stop needing medical devices. So for Medtronic to be the leader with the best dividend, yet they actually trade cheaper than the competition, that doesn't make any sense to me. And granted, there are several reasons for the stock to be dipping, like the pandemic shutting hospitals down and causing supply chain disruptions for their devices, and even delays in their surgical robots, all of which caused a slowdown in revenue growth. But I feel like people act like stocks should be on sale and also having the best year ever in terms of performance, which is just ridiculous. It's not realistic. If you want a sale price, if you want to have a good deal in a good quality stock, well, there needs to be at least some type of issue to drag that stock lower, some kind of short-term speed bump that will get you that lower price, get you that sale price. And that's exactly what I think is going on here. Some short-term challenges that will eventually be fixed by Medtronic. And in the meantime, I get a great stock for a great price. It's a little bit of a trade-off there, but you have to have that long-term mindset in order to benefit from getting good prices on good quality stocks. So that's how I feel about Medtronic, and I'm going to continue to buy shares at these levels while I still can. With that said, though, let's go ahead and move over now to stock number 2, where we will increase the risk a little bit, but I feel like it's still going to end up here with a very similar situation. And that's because this is the food and poultry giant Tyson Foods, ticker symbol TSN, which, just like Medtronic, this is a beaten down leader that nobody seems to think can overcome some of these short-term hurdles. Now, normally this is a very large and dominant company with strong financials as the world's largest producer and seller of meat and poultry, with some of the biggest brands in the space like Tyson, Jimmy Dean, Hillshire Farm, Ballpark, Sara Lee, and many more. Plus, they even have future potential among new growing trends like air fried foods and plant based alternatives. However, the stock can be cyclical at times and is currently going through the biggest drop that I think I've ever seen in it, down about half its entire value. Now, that's not to say that there isn't good reason for that, but again, just like Medtronic, it's short-term pain that must be accepted if you want to deal on a stock like this. Now, the biggest of these issues, by the way, is just the cyclical nature of the meat and poultry markets, which is really out of Tyson's control because beef, pork, and chicken are basically commodities with prices fluctuating based on market supply and demand, as well as the strength of the consumer and the macroeconomy, which aren't at all Tyson's fault, yet the stock is getting punished for it regardless. Interest rates, for example, have been on a tear over the past couple years, rising faster than really any other period in decades, which not only pose a risk of recession, but are already weighing heavily on consumers too that have to tighten their budgets because of it. On top of that, inflation has caused feed prices to skyrocket, which are Tyson's largest input costs for their business. The result of all this is that sales fell in 2022, but more importantly, profits crashed into negative territory on a GAAP basis as well. Now, granted, they are positive when adjusting for temporary one-off events, but the point is that Tyson's business is hurting, and that's really scaring investors into selling out of the stock in droves. But just like Medtronic, I think this is another example here of when to be greedy when others are fearful. Because first of all, the meats market is really never going to go away. I mean, just in America, the average person consumes 225 pounds of meat every year, and the country is also the most consuming of it in the entire world, which happens to be where Tyson dominates. But this story is basically the same globally too. In fact, global meat production has doubled in the past 30 years, with more than a 4 times increase since the 60s. And looking ahead, meat consumption is estimated to reach as much as 570 million tons by 2050, which would also be twice as much since 2008. So given that Tyson is the largest player in the entire world by market share, it bodes very well for them recovering over time. Again, this is a cyclical type of company and stock. They'll likely have their down periods, significant ones, and that is something to consider. But ultimately, these will likely all just kind of be buying opportunities if you are thinking long term, as the valuation has really now dropped to 74% cheaper than the sector on a PEG ratio basis, which is pretty crazy. And the dividend yield has also risen to one of the highest levels it's ever been to. Granted, if things keep deteriorating in the macroeconomy, then that dividend could be at risk of being cut. But with the Fed now likely to lower rates in the coming year, it should alleviate at least some of that pressure for them that they've been facing going forward. In fact, Bankrate estimates at least 3 rate cuts in 2024, with investors pricing in as many as 6, while UBS analysts are also predicting a fall in rates to below 3% by as early as next December, with also 17 of 19 Fed policymakers eyeing lower rates as well. So, while this typically cyclical stock is in a downturn, I just feel like I want to be a buyer of it. And look, we could go back and forth here arguing about whether this time will be different and maybe if Tyson is going to go under, given some time. But I'm not a believer in any of that. I actually think that this is a tested veteran leader in the space with the size, dominance, and expertise to really survive long term. And frankly, I don't see anyone else really being able to dethrone them either. So I like this stock here. I'm going to continue to be a buyer of it. All right, guys, it's time now to finish up though with the third and final stock of the list. And this is also going to be our highest risk option. And this month, I'm going with a stock here that I have never even mentioned before on the channel. And it's a brand new stock that I'm just now starting to research myself. But already, it's become one of my closest watched stocks on my watch list. And I'm heavily considering opening up a new position in it because that stock is Fiverr International, ticker symbol FVRR, which just like the others, it's been heavily beaten down, having already crashed by over 90% from its pandemic fueled high of over $330 per share to now trading for just the $20 range, which is pretty crazy. So what exactly happened here? Well, if you've never heard of Fiverr, they're an online freelancing company, meaning that they connect workers, usually in the digital gig economy, with businesses, especially smaller ones looking to quickly hire a worker for a specific project within a certain time frame and a budget. And this can be in areas of things like graphic design, writing, programming, digital marketing, social media, website and app creation, even artificial intelligence, and all kinds of other things just like that. Which during the pandemic, the lockdowns really sent the stock skyrocketing as many physical stores struggled while online businesses absolutely thrived and thus needed to hire extra workers to help with setting up and managing things like online stores and their digital advertising and content creation, their presence on social media, all kinds of stuff just like that, which it also sent Fiverr's revenue rising as well. However, like most pandemic fueled stocks, Fiverr proceeded to crash once the lockdowns were lifted and all the economy was really left with was sky high inflation and rising interest rates that would likely send us into recession, which would obviously crash the economy and cause all of these hiring businesses to either go under or at the very least pause any new hiring and maybe even start firing those workers, which would obviously hurt a sort of recruiting type of company like this in a big way. I know Fiverr doesn't like to think of themselves as a recruiter, but there are some similarities there. Regardless, though, that's not really what ended up happening. And given that interest rates are now expected to fall in the coming year, I'm starting to think that Fiverr might actually be an ideal stock to pick up on the dip, especially given that they estimate their addressable market in just the US alone to be worth nearly $250 billion. Last year, for example, Fiverr didn't even make half of $1 billion. And with the vast majority of that still taking place offline, they also have an opportunity here as a digital leader to benefit from all of that new growth too. I'm not saying that Fiverr is going to be making those kind of numbers, but I'm just saying that there is space there for Fiverr to grow. That's all I'm saying. On top of all that, though, as an Israeli-based company, Fiverr has also done a great job expanding internationally as well, and really diversifying away from just the hiring of individual one-off freelancers for the gig economy to small businesses, into now one that is also helping much larger clients with larger workforces that require more services on a regular basis, like, for example, Unilever. The result of all this is really just bigger takes and bigger cuts of the pie for Fiverr, which is why we've seen their active buyers as well as the average spend per buyer increase by over 30% a year since the pandemic. And it's not just sales, but actually profits that are getting better too, with their adjusted EBITDA margin going from a negative percent pre-pandemic to a positive single digit during the pandemic to now a double-digit percent post-pandemic, which is a pretty good sign. Granted, net income has been negative. That's all, it's always going to be a speculative stock when you've got those kind of numbers. But for a young company to be growing like this, I actually care much more about their operating and free cash flows, and both of those have actually been positive for years, with free cash flow, by the way, nearly 5xing in size since 2020. And because of the stock crash, when you couple it together, you actually get a pretty good valuation of a price to free cash flow that fell from over 600 a couple years ago to now just 23. And the sector median, by the way, is even higher at 27. Now, granted, growth is slowing down right now with revenue growth falling to the single digits this year, but next year should be a reacceleration to the double digits while EPS growth continues to soar as well. Couple that with the falling stock price that is even lower today than the lowest analyst price targets, I think you've got a pretty compelling option here. I actually just made a video about my portfolio recently. If you happen to watch it, you know that there's a specific portion of it, like a category in my portfolio, that I used to allocate towards specifically speculative type of stocks, companies like Fiverr. And I actually think Fiverr would be a pretty nice fit there because I limit those positions to like less than 1% each of the portfolio. And the cool thing is that over time, if the company gets better or I start to feel more confident in the stock, then I'll gradually increase my buying in that position and maybe even move it over into one of the core sections of my portfolio at a later date. But basically building this up into a larger position, the more that I trust it and the more confidence I build with that stock. So Fiverr is actually looking like a good candidate specifically for that. So I might actually pick it up soon. I am very tempted right now. And I'm even thinking about adding it to the community portfolio as well. So let me know if you guys would want to have that one in the community portfolio too. And by the way, I'm going to make a update video for this month here, January, for the community portfolio. It'll be probably the next video that comes out. So keep an eye out for that. It's going to be a ton of fun too. But anyway, that's going to do it for this month's video. What do you think about the stocks that I featured today? Do you like any of these? Do you happen to own any of these? Or do you disagree with anything I said? I'd love to hear your thoughts and feedback, and let me know what stocks you guys have been buying, because I can always make videos about those stocks in the future too, if you'd like to see that. But anyway, thanks again for stopping by, my friends. Thank you for all your support. It really means a lot to me. Hope you're all doing well, and more videos to come for sure this year, and I will catch you guys in the next one. All right, take care, everybody. Bye-bye.